So, welcome to the Untold Secrets, okay? Mastering the Charts by Cobraclay, me. As you see here, this is completely free and I hope this knowledge serves you right and you can learn or pull some nice informations which could be beneficial for your trading completely for free since I don't sell anything to anybody. Everything is completely free and this lock will soon get unlocked and you will understand a lot more things clearer. And if you want to support me throughout this journey, simply just join my Telegram. It's linked in the top left and also below this video in the biography. Otherwise, just stick with it, learn, keep it simple. The table of contents, we will hop over order blocks and CISDs, okay? IPDA, market structure, true market structure, liquidity, ICT kill zones, ICT Judah swings, ICT's turtle soups, which only have 3 examples, Cobraclay turtle soup, fair value gaps, weekly and daily bias, most likely weekly, quarterly theory plus the AMD, accumulation, manipulation and distribution, market maker models and the time frame alignment to the market maker models, which most of you have never even heard of because market maker models are correlating perfectly with their higher time frame outlook, key areas, and their lower time frame market maker models. The power of 3 in correlation with AMD, OHLC, and also comparing it to CRT, PD areas, equilibrium, and the optimal trade entry if it is really needed, if you can understand everything which we will go over before. Silver bullet, which will be perfected and called Cobra's bullet, which is simplified, and then I will show you my model plus my entry. We will immediately hop over the performance overview where you will now see 3 categories, the main categories. Upon completing this course, you will witness substantial development in these criteria in your life and in trading specific. ICT's knowledge, so you will gain insight into the logic and strategies employed by some of the most successful traders in the industry today. Yes, ICT may not win the Robbins Cup, but still ICT has some nice systems and strategies, concepts out there that make sense but just get explained too complicated, which I will completely simplify for you. So you have no need to learn through boring ICT videos where you will fall asleep after 20 minutes since it's just monotone and boring. Time and price, which comes back and comprehends into markets, simple price action and everything that is going on in there. You will gain a comprehensive understanding of how time and price interact with each other. So there's no Y without the X and there's no X without the Y. Covering every aspect from A to Z, okay, everything that you will need to understand the markets and see them as I see them, simplified, perfectly fine, and also how you can apply your ICT concepts. Equipping you with the knowledge and skills to trade independently because that's what we want. We will have a look in my knowledge, Cobraclay. We will explore my strategies, which are streamlined for simplicity and designed to help you achieve profitability within just a few months. I don't guarantee you anything. I say that you will get profitable if you only focus on the things I teach you. Since I did it, a lot of other people did it in a few weeks. I have physical, mental, psychological, whatever proof that you want to see screenshots in my Telegram and daily screenshots which I get sent from strangers and individuals where they see huge success in their trading career, taking trades, and just maybe just even adding some things to their yet still strategy that they already have, but simplifying it. So simplicity, keeping it clean. And I decided to design a new concept, and I hope you will enjoy these videos, which will come out in 5 episodes, which will be broken down just like Netflix series. The first thing is the order block, or the CISD. We'll hop over both, and an order block is the last bearish candle in a bullish trend, or the last bullish candle in a bearish trend. In this case, we have the last bearish candle in a bullish trend. Okay? A bearish order block is confirmed when the price closes below the last bearish candle's low. So the low that broke the high gets candle closed. While a bullish order block is confirmed when the price closes above the last bullish candle's high. These zones are used to predict potential reversals or trend continuations, okay? Order blocks, as you may see it in this picture right here, is the low that broke the high gets candle closed, or either the high that broke the low gets candle closed, okay? So, order blocks plus CISD. Here you see some nice examples of a bearish order block, which is confirmed when the price decisively closes below of the last bearish candle, which we just learned, indicating strong selling pressure on a potential continuation of the downtrend. Okay. Conversely, a bullish order block is confirmed when the price closes above the high of the last bullish candle, signaling that the buying momentum has overpowered the previous resistance and may lead to further upwards movement. Simple as that. These confirmations help traders identify the key zones of institutional activity and align their trades with the prevailing market trend for higher probability setups. What does that mean? Simplified is just the high that broke the low, the low that broke the high. First example, here you see you dig into a nice key area, and then you see a low getting formed, a small swing low, taking out the previous high. So the low that broke the high gets candle closed a few minutes later, okay, a big black candle as you see it here in the bearish order block, and then the order block in itself gets rejected, okay. You see nice momentum coming into this order block, getting into there and rejecting it, or seeing a nice reaction from it and pushing lower, breaking even lower structures and continuing the bearish trend. Sorry. For the bullish order block, it's exactly the same. You just wait till you dig into a key area, or for reversals or whatsoever, you see the high, which broke the low, gets candle closed beautifully. And in this case here, you have a very big order block. The order block is considered the whole swing from the high that broke the low gets candle closed. This is the order block, nothing in between, nothing other, not the last candle, whatever, the last swing. Okay, you can still refine it to the last candle, but then it's a refined order block and it most likely won't 100% work out all the time. What you can do is there are two types of different order blocks. There are high probability order blocks and low probability order blocks. Okay, there are two primary types of order blocks that traders recognize. First, the high probability, which are characterized by large robust candles that penetrate a significant key area, and on the other hand, just slow moving markets consolidating or even just forming doji candles. The order block refinement. An order block can be refined to minimize the stop loss and maximize the potential outcome of a trade. To increase the profitability, traders may apply the 50% rule, which involves focusing on the midpoint of the order block for more precise entries. This strategy can enhance risk management while optimizing the trade performance. Here you see the low, which broke the high, gets candle closed. This here then from the swing low to the swing high, which broke the past high. You can draw a Fibonacci tool around it or just a range tool. And you see the 50% gets touched immediately. Or you see the 50% as a discounted area, as a PAD area, and you want to see cells in there, which we will later on get into in the series of these videos. The CISD can occur in the monthly, weekly, daily, such in the 4-hour. Okay, the change in state delivery, also referred to as a market structure shift, terms like break of structure or change of character, market structure shift or CISD, which is all the same, is identified by the candle close in either a bullish or bearish direction. You may know that I repeat myself a lot of times, and the low that closes the high, the high that closes below the low or whatever, and CISDs and order blocks will repetitively get digged into your brain because it's so simple to understand but yet still effective. So I want you to focus on these things, because the traders that do the boring stuff for the longest will most likely succeed in anything in life. Trading isn't hard. The hard part is doing the boring stuff over and over again because it doesn't give you a dopamine hit. This concept was introduced in the order block series, emphasizing how price action breaks key structural levels, confirming potential trend reversals or continuations. For the monthly key levels, you go down to the daily time frame for your order blocks. Okay, so if you hit a monthly swing low, swing high, order block, FVG, whatever, you can go down to the daily time frame and mark out your order blocks, your CISDs, your change in state deliveries, whatever you want to call it. In the weekly time frame, in the weekly key areas, you go down to the 2 to 4 hour time frame for your order blocks, for nice refinement or to see your CISDs. Same for the daily, you go down to the 15-minute and you look for clean order blocks. And for the 4-hour, which is intraday trading, which we will get into in the CRT lessons, you will hop into the 5-minute for your nice CISDs. For the people who are a little bit more advanced, you will already see and already understand what a 5-minute CISD means in the 4-hour, but for those who are completely new, it doesn't matter yet. You will still learn, and we will get into everything later on in this course. This example illustrates the breakdown and significance of change in state delivery, CISD. We begin with the weekly chart, okay, that highlights a major key area that has been tested, in this case a swing high, which gets rejected. From there, we can transition to a 4-hour chart to refine our entry strategy, utilizing either the entire swing point or by focusing on a more specific order block refinement. This approach allows for more precise trade execution based on observing market behavior. So here you see the weekly time frames or the weekly candles broken down in 4-hour charts. On the bottom right, you also see a nice picture which will help you understand this clearer in the future, because I want you to watch these episodes not one time, but at least 2 or 3 times, because a lot of people of you watch Netflix series over, 12 to 10 to 15 times because they never get boring. And if you watch these videos again and again and over, you will see so many correlations between these pictures, because nothing I command and nothing I say out of my word and out of my mouth, which is combined with my knowledge, is random in these videos. These videos took me a long time. They are not pre-written, but I literally look at the picture right now and I speak from my true soul, true heart to you with the correlations of every single picture, videos and episode you will see in between here. Everything has a correlation, and also the picture on the bottom right has a correlation with the power of 3, the OHLC, market structure, AMD, and quarterly theory, which you will soon learn in the new videos and the new episodes. For that, we now hop into IPDA, the intra-price delivery algorithm. The IPDA algorithm ensures that market movements align with logical and structured principles. Very simple. Price behavior can be categorized into 4 distinct stages, and at any given time is engaged in one of these 4 activities. There are no other possibilities beyond these core stages. You have the consolidation state, the expansion, a retracement, and a reversal. IPDA, what can price do? Price can go from expansion to retracement. So if you see an expansion, a big move, you can always see or wait for a retracement. Price can go from an expansion to a reversal. Same as a retracement, which is just a small pullback. You can still see reversals if you expand in a key area and you hop down lower and you break down your chart in the time frames, which you just learned in the order block series, and you see an order block and you see a CISD, then an expansion can go from an expansion to a reversal. Price can go from an expansion to a consolidation. As I've taught you and taught you over the few videos I've already released, and I will soon also release the new videos, market has 2 ways to move: consolidate or expand. Price always goes from a consolidation to an expansion. Always. You always build up liquidity, and after that you may see a liquidity grab, a turtle soup, or just a manipulation, and then you will 99% of the times have an expansion. Price will never go from a consolidation to a reversal. You will never see price going into a key area, consolidating and not grabbing liquidity, and then reversing. Dixie will give you a correlation, GU will give you a correlation, or EU will grab the liquidity, but there will never ever be a consolidation to a reversal. There will also never be a consolidation to a retracement. Here you see the 20, 40, 60 day IPDA algorithm. In trading refers to how large financial institutions move and deliver prices within the markets over specific time frames, okay? The 20-day, 40-day, and 60-day ranges help traders analyze price behavior at different intervals. The 20-day range provides a short-term view identifying recent trends or potential reversals. Write that down. While the 40-day range offers a medium-term perspective for better context, understanding if major swing lows, swing highs get broken, or whatever is going on in the markets, which are key levels which we will get later on in the series in depth. The 60-day range is a long-term outlook, helping to spot significant market shifts or key levels, and these ranges allow traders to understand price delivery and identify areas of imbalances, an imbalance where prices may be drawn to or rejected from, either swing highs, swing lows, or internal liquidity. Market structure. Market structure. Most of conventional wisdom surrounding market structure is incomplete, leading many traders to suffer losses, often due to placing stop losses below key lows. In reality, true market structure operates differently. Okay, here you see 2 examples. Market structure explained from gurus, ICT students, and 99% of traders out there, because they haven't known that market structure in itself is incomplete because there's missing information. They simply view it as lows, highs, higher lows, higher highs, and then market shifts, but they don't know when, and they get stopped out before or later, and then market moves in the continuation or even gives you the reversal. True market structure, though, operates differently. In a bullish trend, it consistently rejects lows and breaks highs. This isn't just yipping and yapping, and I show you here a live example on the charts where you see lows, swing lows getting rejected by wicks, only wicks, not candle close, just wicked below. And the highs get candle closed. That's where most of the people pull their stop losses, below the last swing low. The first here on the fourth picture on the bottom left is the perfect example, because you see here in the chart example a swing low getting rejected where 99% of traders will have their stop loss, but then continuous pushing higher and then breaking the high. While in a bearish trend it rejects the highs and breaks the lows. Understanding this nuanced behavior is essential for improving trade outcomes and avoiding common pitfalls in trend analysis. Also, some of you may have heard about falling knives. Falling knives from ICT is nothing than a turtle soup, is nothing than rejecting a low, is nothing than stopping out a lot of people, and you don't want to catch a falling knife, do you? Because then your hands will most likely bleed, and after that you can pull it up. So you wait for the knife to fall on the ground to stop some people out, to come into some nice key areas, swing lows, rejecting a low, and then pushing in the opposing end of the range. The true difference is true market structure depends on rejecting lows and breaking highs in a bullish trend, since you need that momentum to break the high and close above it. Such as in everything in life, you need that momentum to break free. As Tate said, a rocket needs momentum to break through the atmosphere, it can't just stop midway through. Smart money traders, YouTube gurus, and all the ICT people selling courses and demanding you to understand market structure will simply tell you like follow that there are highs, lows, higher highs, higher lows, higher highs, higher lows, and so on and so on. But we know, as the traders who follow me and only me know, that lows or highs get rejected depending on the bias. Market structure and its key levels. Key levels, when combined with basic market structure, provide one of the most straightforward and effective methods for confirming market direction. Because here we highlight three of the most commonly used key areas, which will be revisited in greater detail later. You have rejection blocks, which are big wicks, which can also act as order blocks. You have fair value gaps, which act as internal liquidity, and another rejection block, which is just a wick. But you see, lows get rejected, highs get broken. Internal liquidity gets rejected, highs get broken. External liquidity gets broken. Key levels, key areas in the market serve as indicators for either trend continuations or potential reversals. The most critical areas that we will focus on include order blocks, rejection block, breaker blocks, swing points, so swing highs, swing lows from M5 to 1 hour even, fair value gaps, and inverted fair value gaps. These zones provide valuable insights into market sentiment and are essential for identifying high probability trading opportunities, because without these 6 key areas marked in this ring here, markets would be just nothing, not even understandable. That's it for the first video. In the next video, we will hop over the liquidity part, the ICT kill zones, ICT judo swing, ICT turtle soups, and Cobraclay's turtle soups. I hope you enjoyed it. Stick with these videos. Try to learn as much as possible, write everything down, and I hope you enjoyed episode 1 of 5, and I will see you in the next episode.